Folks, you better brace yourselves because insanity, complete insanity is coming. We are entering what will be the most critical week for the stock market all year, and perhaps for the next couple of years. So in today's video, we need to break down three things. Number one, election day odds and statistics on how markets tend to react. Number two, the Federal Reserve meeting happening this week, what you need to know, what is likely to happen, and what the Fed is looking at and what that means for our money and our accounts. Number three, the massive earnings reports that are coming out this week and what you need to know and what you need to look for. We have our darling Palantir reporting tomorrow night, so make sure that you're tuning in to understand exactly what we need to look for. And as always, before we get into it, if you're the one taking the risk, you got to be the one doing the ultimate frisk. Make sure to do your own due diligence on all ideas presented here on the channel. And also, if you'd like to get our daily free email reports, make sure to sign up with that first link down below. We've got some really hot, in-depth reports from our team coming out in the next couple of days. And if you're trading this election, you'll want to be reading those reports. Okay, let's get to work. So let's start with what's happening on Tuesday. So there's a lot of heat right now about elections, and certainly the candidate that ultimately wins will have a huge impact on the economy, global trade, the stock market, so on and so forth. However, ultimately, it's important to remember that your success in the market is not based on who wins, but based on your own decisions and your own actions. Regardless of the seas, remember, you are the master of your own ship. Yes, certainly you might still hit an iceberg, but if you avoid that selfish lady named Rose and get that last spot on the door yourself, you secure that last door for yourself, well, you should be fine. Folks, with all the drama aside, the fact of the matter is that markets have, of course, trended up in the long run, regardless of who's in power. Since 1933, with 8 Democratic presidents and 7 Republicans, the market has continued its upward march overall. This means that while the noise is loud and the tensions are high, and quite frankly, the risks are pretty high as well, if you look at market madness dating back to the beginning of 1933, it tends to be short term, and it tends to be the case that markets go up overall, regardless of who is in office. Which means what as a trader? Well, if you put on your trader, your market participant hat, that means that you can look at drama in elections as any other kind of drama. An overreaction for us to look at objectively without emotion and profit off of. Let other people fall for emotions. Let other people panic. It's our time to exploit the condition and seize the opportunity, just like we did in the 2020 COVID crash, just like we've done in many other market conditions where you have euphoria or dysphoria. You buy the overreaction, you ride the market back up, and you take that profit home to mama and papa. Now, that being said, each candidate does have different sectors that they are better for. We talked about this chart here from Tom Lee's Fund Strat, and they found that markets think Trump is better for regional banks, Bitcoin, financials, materials, the Russell 2000, small cap index, which of course those tend to pump with low interest rates and more isolationist policies, because isolationist policies allow the up and coming companies to get a huge head start and more investment since they have complete access to our home market here. And then also staples, real estate, and then they think VP Harris is better for communication services, energy companies, especially those who drill abroad, technology, industrials, healthcare, and utilities. Markets seem to think a President Harris would have similar impacts on the market as did President Biden. Companies that tend to do better with inflation, companies that have pricing power, so on and so forth. Now, when it comes to what people are worried about right now, obviously you have the presidency, but what about the bigger picture? What about the makeup of the overall government? Isn't that equally, if not more important? Well, of course, the makeup of the government is really what is going to determine what policies get pushed through and which don't. So thus, it would lead somebody to expect that to be the thing that matters. However, the market statistics on this are a little bit different as well. It tends to be the case that a unified government returns 14.4% in the S&P 500, a unified Congress and president and other party returns 11.7%, and a split Congress is at 13.7%. So again, these are all kind of within the margin of error where it almost doesn't make a big difference. The way that government should ideally be, I know that it's not always like this, but the way that it should ideally be and has been historically is the government acts as more of a referee than anything. Corporations, American workers, and American consumers are the ones that drive businesses, business growth, and the overall economy, and thus the stock market up, not the government. So as long as the government doesn't get in the way, then American innovation can allow these companies to move much higher up. And that has been the case historically. But at the end of the day, you can bet on the market going up because people here in this country get more crafty. They get more smart. They're able to create better and better products, which drive more and more growth. Now, going back to this Tuesday election day, certainly government policies and appointments can help or hinder growth. But bigger picture, it's our job as stock market participants when we put on that stock market participant hat to look for ways to make money. When you have the voter hat on, then you can decide which policy you like better. But when you have your market participant hat on, that is time to exploit. Now, that being said, just because things have historically done well, regardless of who wins, that doesn't mean that certain sectors aren't going to do better or that the next candidate might not just screw up the long-term trend. Look, folks, I'm not going to beat around the bush. I personally believe in less taxes, less dumb regulation. Some regulations make a lot of sense. A lot of them don't. Less useless bureaucracy, and more of an emphasis on free markets versus an emphasis on government picking different areas that need help. Just look at the crypto sector, which has been bludgeoned again and again by endless regulatory attacks the last couple of years. Regulators have refused to provide clear guidelines on the crypto sector and have instead decided to rule through endless litigation, which is horrible for an industry that's trying to develop. Now, crypto has succeeded despite all of those headaches. However, clearly how you regulate something matters. But it's also true that bigger picture, both parties, if you're a Dem, you're a Repub, well, both love to spend more than we take in, and government spending has a huge impact on the market as well. It's called artificial stimulation. Remember, governments can spend their way into prosperity in the short term. It's kind of like you have a credit card, you spend a lot of money, well, now you got a lot more stuff coming in. In the long run, you create problems, but again, as long as you can keep spending endlessly, things are good for a while. You gotta remember that Congress also has massive incentive to make sure that companies make tons and tons of money. As you know, if you watch this channel, most Congress people have major conflicts of interest wherein they have no choice but to look out for corporate interests and corporate profits, oftentimes first as a first priority. Why? Well, because they are either invested in the stocks themselves or get money from different PACs or different direct donations for their re-election campaign. Now, from a stock market perspective, this is a good thing because you know that they're going to be backing the stock market. From an American perspective, not so good of a thing. You'd rather have politicians that are looking out for their people first. But hey, you know what? We don't live in a utopia. We didn't create the game. We just live in the game. Now, what exactly are markets pricing in right now? Well, some say that the market is pricing in a Trump victory, and others say that when markets are up heading into an election, it means the incumbent party is favored to win. However, there's many different conflating factors here. I would say if you look at the bigger picture and the overall trend, it looks like the stock market specifically, maybe not the betting markets, but the stock market specifically still favors Trump, because if you look at the types of equities that have been highlighted in terms of appreciation the last couple of months, well, those match the ones that markets traditionally think would be winners under Trump. So accordingly, if he does lose, you would expect these to see an abrupt sell-off, and at the same time, if she wins, you would expect these to see an abrupt uptick. Now, I want to talk to you about sideline cash. So historically, during an election year, you tend to have super low new net funds allocating into equities and super high net funds allocating into money market funds. And then that dynamic completely reverses in the year after the election. Now, this election cycle that we're currently in happens to be coming at a time where we have unprecedented cash on the sidelines already, thanks to the overlap of the Fed hiking cycle incentivizing money to stay invested in treasuries. But now that we're in the beginning of a Fed cut and we're also in the beginning of the end for the election, well, that major trend should completely flip, which means that much of this $6.3 trillion in unprecedented sideline capital will start finding its way into equities and other assets in the next 3 to 6 months, assuming no economic collapse or Fed reversal of policy. Now, on the subject of economic collapse, we need to talk about this jobs report. Friday's jobs report showed the U.S. added only 12,000 jobs in October, which was pretty horrible, but it does suggest that the Fed has more room to cut rates, and it also looked even worse because there were major disruptions like the Boeing strike and 2 hurricanes that impacted the data collection by quite a lot. However, bigger picture, we are heading in the wrong direction. This is the pre-COVID trend, and this is the trend plus hurricane/strike. My guess is you're probably going to see the real data after the election and after we get all the revisions in, so I don't want to comment too much on this, but I do want to talk about what the Fed's going to say this week. So while the country votes, the Federal Reserve has its own big move lined up just 2 days later, making this a pretty damn insane week. But inflation, as you know, has continued to cool down if you believe the official numbers, and that means we're about to see the Fed cut rates for a second time this year. The Fed's expected to cut its benchmark rate by 1/4 point. High borrowing rates have put a massive squeeze on higher multiple stocks, on growth stocks, on small cap stocks. And that means that those are going to be set to rally massively as rates get cut. And of course, the best ones like your Palantir, which is now a mid-cap stock, but the best ones have gone absolutely parabolic. As they cut, you should expect those to do even better. And depending on who becomes president, you might see them appoint a chair that decides to cut rates lower. And if Powell stays, again, he's dovish right now anyways. What markets are going to be watching is how the Fed is going to react to policy proposals that both former President Trump and VP Harris have suggested. Some Fed presidents have said that tariffs might be an inflationary pressure, which might mean that the Fed will guide a little bit lower in terms of cuts, or a little bit weaker in terms of cuts. VP Harris, same thing. They might say, well, you know what? She's talking about raising the minimum wage. Mentioned in the past, spending packages for green infrastructure. These things could also push up inflation. And these are things the Fed is going to comment on. And if we know who the president-elect is by this Fed meeting on Thursday, well, the Fed's going to go very, very much into those details, and it's going to have huge ramifications for the market. Now, of course, when whoever gets into office, they can fire Jerome Powell and change a lot of the policy trajectory. But again, the Fed system, you have different Fed bank presidents, you have different people that all come together to make a decision. So whatever Powell says is going to be the general trajectory that most of the people within the bank think that they're going to be following. Okay, now let's go ahead and talk about earnings reports. So we've got some mega ones reporting this week, folks, including one of our highest conviction stocks, the tier of the Palant. Now, Palantir Technologies will be reporting tomorrow in the after hours, and the analysts expect the lovely Palantir to showcase growth driven by demand for AI solutions, particularly with its AIP platform, which has been a major growth engine this year, and we've talked about many times. As AI becomes critical in defense and corporate sectors, any updates on new contracts or expanded capabilities will be significant, and mark my words, there's going to be some massive updates, and you're going to see it covered all around the financial media. Now, in terms of reactions on the stock price, Palantir stock typically shows substantial volatility after and before earnings reports. Usually you see a bit of a sell-off before an earnings report, and then if it beats, massive pumpito. Now, the stock has already gone up a lot this year, which means expectations are sky high, and quite frankly, when expectations are sky high for Palantir stock, and Palantir has a little bit of a hiccup in one line of the report, you'll see the short sellers start pumping out negative pieces on the stock, and then it makes it easy for it to sell off. This time around, I think they're going to blow out, but I'm cautiously optimistic just because we've seen so many blowout quarters for Palantir where the stock will dump. In terms of key metrics to watch, you want to focus on revenue growth, profit margin, forward guidance, and of course the scaling up of different contracts. We love the system that Palantir has where they have a new client, they get them into their boot camp, and then they slowly scale in that client until the contract is 10x'd in value just for one client. And if Palantir can continue to report that they're doing that amongst many clients, well, that paints a really good trajectory for the overall forward momentum of the stock. Number 2, Super Microcomputer SMCI. So obviously this one is going to be a doozy because we just had really a big dramatic week for the company. This report is going to be especially watched closely given recent issues surrounding the resignation of Supermicro's accounting firm over concerns about their financial reporting. If you have an accounting firm saying, hey, we're not so sure that we trust your reports, well, that's a big stinking issue. And that's something that markets are going to be watching very closely. It's going to be very closely scrutinized. I don't even know if people are going to trust the reportings that SMCI makes. But on the flip side, if they can do something to quell investor concerns, well, you might see an overreaction bounce. Okay, number 3, ARM Holdings. So their earnings date is on November 6th, and ARM is a leader in semiconductor design. It's tied closely to global chip demand. Global chip demand has been on a hot plate all year. And the licensing revenue and the overall business structure of this company is completely astounding. And we made a top 9 stocks video to buy before the end of 2024. We posted that a couple of days ago, and it was one of the top ones on the list because this is such an incredible business. And what we want to watch this week is the licensing revenue growth, the AI and IoT partnerships, and commentary on global chip demand. ARM is relatively new to public markets, so you get a little bit more volatility with that. But again, I'm hopeful for ARM. Number 4, AMC, the king of the short squeeze candidates next to GME. AMC stock has historically been very highly volatile around earnings, particularly due to the retail investor interest in a squeeze. But in terms of what to really watch here, you always want to watch revenue growth, foot traffic, debt management, and any expansion plans. I've been highly critical of AMC for a while because of their dilution. I don't like that they're diluting the dilution boat constantly. It's ridiculous. But it is what it is, and I just got to tell you, if you're focusing on this stock, you want to be looking at revenue growth and debt management specifically, because that's the whole goal of the company, to use all of these offerings to solidify their company and put it on a nice path for the future years. Number 5, Qualcomm QComm. Their earnings date is on November 7th. Qualcomm's earnings will reflect broader smartphone and 5G market trends, which will affect other areas of the market. Look closely at mobile chipset sales, revenue guidance, 5G adoption rates, and new client partnerships. You also have DraftKings. I don't know if I care too much about DraftKings right now. User engagement metrics are important to watch, though. Updates on state level legalization. You're going to hear a lot about that with this upcoming election. It's not on the ballot on many states, but it's on the ballot in some of the states. In terms of the trade desk, that's another one that I'm very interested in. Watch revenue growth, market share gains, and trends in programmatic advertising demand. Pinterest, that's another interesting one. Watch monthly active users, ad revenue growth, and any new ad product launches. Airbnb, sometimes I'm interested in this one just because it can be indicative of consumer health. I mean, if you're looking at booking growth, average daily rates, and forward guidance on travel demand, well, you can learn a lot about the American consumer and how they're doing. Anyways, needless to say, whether it's the election, the Federal Reserve meeting, or all of these earnings reports, there's a lot that's going to happen this week. It's a very conclusive week, so make sure that you're paying attention and make sure that you're ready, and we will see you in the next video.